Good morning. I want to welcome you to the final week of our webinar series this spring, early summer, on business succession planning issues for small business owners. Today's topic is the uses of life insurance in your succession plan. Our speaker today is Jim Awesome with a law firm, Kavich, Famillo, Durkin, and Frutkin up in Cleveland. Hopefully I pronounced that name correctly.
Close.
Close? Okay. Not quite. Just, as you can see, they kind of just go by Kavich right now. So I'm going to, from here on out, I'm just going to refer to Jim with being with Kavich up in Cleveland. And Jim's a longtime supporter of our program, been presenting for many years with our program, does an excellent job. And he's going to talk about life insurance today. And the good thing is he's not going to try and sell you any life insurance today. But is very knowledgeable on the subject. So we're pleased to have Jim here today. And I think without further ado, I'll turn it over to you, Jim.
Chris, thanks very much. Good morning, everyone. I've been doing this for, some 35 years and have focused my practice primarily on succession planning for business owners in the last 20 years and have been involved with the Ohio Employee Ownership Center and some other groups. And that's been quite a rewarding task. I try to use a practical approach to succession planning, and part of what I do is I use phrases that I hope clients or other advisors will remember and can relate to their businesses. And the first thing I do, which is on slide 1, is I always, when I sit down with a potential business succession client or their advisors, is I like to talk about the 3 whats. And the 3 whats are essential to putting together what I think is a practical plan, and the 3 whats, as hopefully you'll see, also are very useful when examining what the life insurance applications may be to any individual succession plan. And it's each plan, each business, each set of owners is unique, but following these steps, which is what I've been doing now for 20 plus years, gives you a pretty good approach as to how to put together a plan. The first what is, what does the senior generation require? What I mean there is, do they require a significant amount of cash flow, monetary benefit from their enterprise that they own? Have they been fortunate enough to acquire real estate or 401k or a stock portfolio or have significant assets outside of the business so they don't require a significant value from the business upon its ultimate disposition, their transfer of the business? Most of my clients require a significant price tag, if you will, for their business because that's the primary asset. And when you do the analysis of what does the senior generation require from the business, you must take into account how much they have been taken out of the business that might otherwise be considered personal expenses for years. If someone has owned the business for 25 years, they probably haven't bought a car in 25 years. The business has. They probably haven't paid for insurance in 25 years. The business has. They haven't paid for a lot of meals and other things. The business has. And when they sell the business or get out of the business or cease being an employee of the business, for tax purposes, it is very difficult, if not impossible, if not incorrect from a tax standpoint, to have the business to continue to pay for those things. So when you're doing that first what does the senior generation require, make sure you take into account everything, which includes significant personal expenses that they're going to have to bear on a going forward basis. The second what is, what can the business itself afford? You can see that you have to marry the first two. The senior generation requires X, and can the business afford X? In doing that analysis of what the business can afford, you must make sure that the business itself remains a viable, healthy enterprise. Because if it does not, then the senior generation won't get what it requires. The business will not survive, will not succeed, and of course the successors will not be able to afford themselves the kind of living which they wish. I always tell my senior generation and then the second generation who's going to buy them out, don't expect your parents to take less. They may not want to take more, but they're probably not going to take less. So what that really means when you're looking at item number 2, the second what, is you have to grow the business in order for it to be a successful succession, because we no longer have just one nuclear family that is drawing from the corporate coffers. We have probably multiple members of the generations drawing from the corporate coffers going forward. The third what is the business worth? For example, if the business is worth $5 million as determined by a qualified appraiser, and then you determine in the first what that the senior generation only requires $2 million, then you can devise an intentionally defective income trust. You can devise an installment sale, perhaps a private annuity. A lot of ways to get the $2 million to the senior generation that they require over a period of, let's say, 10 years. Well, $2 million over 10 years on a discounted basis may be worth about $1.7 million with today's interest rates the way they are. But if the business is really worth $5 million, the difference between that $2 million that is going to be paid to the senior generation and the $5 million that the business is worth could be a taxable gift to the senior generation, whereby they were making a $3 million gift to their kids on which they have to pay a 45% gift tax. That could be devastating. So it is essential in doing this planning that you know what the business is worth. And when I use the reference, or what is fair, fair cuts both ways. If the business is worth $5 million and you're going to pass it on to the second generation for only $2 million on a tax advantage basis, that's great tax planning. But are the kids who are not involved in the business suffering a $3 million hit to their potential inherited net worth? And should that be accounted for in some fashion? It does cut the other way, as I mentioned, because if the business was worth $500,000 when the generation that came into the business 25 years ago with their parents, now they've created some portion of that new value. And do they have to pay for what they have created to their siblings who have not been involved in the business? So that's the approach I begin with. That's how I explain it to my clients. And then when you get past that, you have various ways to implement that. For example, insurance can be used to provide funding for the senior generation. I've referenced there in slide number 2, CSV, which stands for cash surrender value. It is hard to accumulate a lot of dollars on a tax-free basis in any vehicles under today's tax structure. But an insurance policy that has a cash surrender value allows you to accumulate cash surrender value, tax-free benefits, if you will, inside the policy, which can then be borrowed out at the time of the senior generation's departure from the company and perhaps be used as a down payment to fund their retirement benefits. The first to die policy, which is bullet point number 2, is, I think, often overlooked and is essential to making sure that the succession plan vis-a-vis the family is implemented properly. For example, if the senior generation is owed $2 million in my example, and they die shortly after the succession plan is implemented and they're to receive payments for 10 years. Well, now the surviving spouse is dependent upon the business for the next 10 years and it being successfully operated. If there is a first to die policy on the senior generation, the transfer or, if you will, in my 3 whats, then the surviving spouse as well as the surviving owners can use that insurance to extinguish that liability in full. And that's great because now the surviving spouse has their dollars on a tax-free basis from a life insurance policy. And because that life insurance policy is now subject to income tax and if done properly, estate tax, or if it's subject to estate tax, it is sheltered by the unlimited merit deduction or sheltered by the unified exemption equivalent, which is $3.5 million. You now have the surviving spouse with proceeds to provide for their lifestyle for the rest of their life with no dependency upon the success of the business. That's extremely important because if you take a look at the statistics, second and third generation enterprises often fail. The percentage of those businesses succeeding on a permanent basis is very low, unfortunately. And so therefore, ensuring that risk is a very inexpensive way to assure that the senior generation, the beneficiaries of that first what do the senior generation require, will in fact benefit from the enterprise, as the enterprise probably in some fashion has paid for the life insurance. The third bullet point under ensuring the 3 whats is a second to die policy. A second to die policy is just that. It ensures both the husband and the wife and provides death benefit, liquidity, if you will, to the estate of the surviving spouse so that the estate may have cash to pay the taxes and therefore the business itself or the second generation does not have to incur a liquidity event to transfer funds from the business or themselves to the estate of the second to die. The second to die is necessary to make sure that the business is exempt from those kinds of difficulties. It's often quite beneficial as well because it can be the vehicle to provide fairness. So we'll talk about it in the next slide. Next slide, I'm on slide 3, is life insurance assures the senior generation gets paid if a successor suffers an untimely death. For example, in my $2 million example, the son takes over the business. The son contracts cancer and dies 2 years into the installment payment. Now what happens? Who's going to run the company? Who's going to make sure those payments for the next 8 years get made to mom and dad from the business enterprise on a successful basis? That is a significant risk. So therefore, ensuring the buyer in a succession plan is extremely important and sometimes overlooked option. But it's a very inexpensive way to provide the senior generation with assurance that they're going to get their economic value from the family enterprise that they've turned over. And I sometimes keep referring to family enterprises. Obviously, when you're talking about business succession planning, it doesn't have to be limited just to family enterprises. These kinds of techniques and the things we're talking about, the 3 whats, and ensuring the life of the seller so that his or her surviving spouse is taken care of, and ensuring the life of the successor, the purchaser, does not have to be family members, but they can in fact be other closely held business owners without any family relationship whatsoever. Key person insurance on successors or managers assures continuity in the enterprises, bullet number 2, is absolutely essential because these businesses do not run themselves. If someone passes away who was a key manager, that's going to impact the business in a probably a very negative way. And if you sit down with your bank, and I can only suggest that it has gotten worse in this lending environment, and do not have a coherent succession plan in a closely held enterprise, the bank will get nervous. And I've even had occasions where some of the major customers have gotten nervous. For example, if you're a Tier 1 or a Tier 2 supplier to one of the major automotive companies, you're probably filing for bankruptcy tomorrow. But other than that, they want to make sure that there's a succession plan in place. And part of that succession plan is making sure that if a key manager or so-called key person does in fact pass away, there's 2 things that life insurance provides. It provides the ability to take care of that key person's or that successor owner's family and buy out their ownership interest. But perhaps more importantly, it also provides cash to go ahead and hire the replacement for that deceased manager who can help run the company. And that can be done, again, on a tax advantage standpoint. Insurance is a tax advantage method providing equalization for family members not in the enterprise. That's bullet point number 3 on slide number 3. Let me give you an example of what we're talking about in that regard. The business in my example is worth $5 million. The senior generation owner requires $2 million. So if a second to die policy is obtained on the life of mom and dad and is owned by an irrevocable life insurance trust, and the beneficiaries of the irrevocable life insurance trust are the children of the family that are not active in the enterprise, then the $3 million that they would otherwise not see as part of the succession plan buyout, which is very expensive, no reason to pay another $3 million if mom and dad don't require it and don't need it on a 100% dollar basis. But if you pay a life insurance premium that will generate a $3 million death benefit, you can pass that $3 million on through an irrevocable life insurance trust to the generation who's not active in the enterprise on a very tax advantage basis. And that's why life insurance is a very effective method of what we call equalization or fairness among members of a closely held enterprise. We tell our clients, if you've got members of the family who are not going to be employed, earning their career, making the family business their career, then they probably should not be an owner of the business. Because as an owner of the business, they are probably primarily interested in taking pot shots at the owners of the business, their siblings, making sure that they're getting some portion of the economic benefit from the business, even though they're not employed, they're contributing to its success. And sometimes they realize that the ownership of the business, because they're deriving no economic benefit in terms of salary, bonus, health care benefits, 401k, or otherwise, represents more of a liability in their estate than it does an asset. Therefore, with the use of life insurance, you can provide a significant economic benefit to the members of the family not employed in the enterprise without complicating the enterprise and without getting the potential acrimony that might otherwise derive from an ownership interest in a business in which they are not an active participant. I'm on slide 4, insuring the 3 whats. And bullet point number 1, premiums are not deductible. That's true. Life insurance is not deductible, period, other than Section 79 group term life insurance up to the extent of $50,000 per year. Life insurance premiums are not a deductible expense. However, life insurance proceeds owned inside an irrevocable trust are free from both income and estate tax. And life insurance proceeds received by the entity, an LLC or a corporation, key man insurance, etc., are also free of income tax. So the proceeds are available to provide significant economic benefit to the owners, to the key managers, families, and to the members of the family who are not active in the business, and they are tax advantaged. And other than perhaps an employee stock ownership plan, there is no effective way to acquire an enterprise with tax-deductible dollars. But at least in this fashion, the survivors, the owners of the insurance policies, can acquire the business with use of the insurance proceeds received on a tax-free basis and then use those to acquire the business. Bullet point number 2, reasonable way for successors employed in the business to buy out siblings. One of the things that I stress when we're talking about the 3 whats, what is a business worth or what is fair, is upon the death of your parents, when I'm talking to the successors, and if you have 3 siblings and you're the only member of your family employed in the enterprise, then theoretically on paper, if nothing else is done, because parents always want to treat everyone equally, you're going to have to buy 75% of the business from your siblings. And if you have to buy 75% of the business from your siblings, from the cash flow of the business on a dollar-for-dollar non-tax advantage basis, that's extremely expensive and perhaps almost cost prohibitive. If, however, you, during the time that you are employed at the enterprise and the time that your parents are employed at the enterprise or before their death, the enterprise itself is being used to pay the life insurance premium on your parents' life, payable to you as the beneficiary under a cross-purchase or stock redemption agreement. Then, upon the death of the senior generation, this so-called insured, the proceeds can be used to buy out the siblings, and you still get a step up in basis. You get all the tax advantages of paying for it with none of the cash flow disadvantages of having to do it on an after-tax basis. So we encourage that the life insurance premium be taken out while mom and dad are still healthy, be taken out while the business is still healthy, and that the business in some fashion be used as a vehicle to fund the insurance premium payments. Bullet point number 3, insurance provides economic benefit to non-employed family members. We've already discussed that, and the key, I guess, to also put there is one of the ones we talked about before as to the senior generation, and that is the people who are not employed in the enterprise do not want to be dependent upon the success of the enterprise to assure them that they are going to receive economic benefit through their inheritance. As we mentioned, second and third generations, I think in less than 50% of the cases, are successful in maintaining the business enterprise on a going forward basis. Therefore, if the value is tied, the family's value, the family's inheritance is tied to the success of the enterprise, that success and that enterprise may not be successful in more than 50% of the cases.
Jim?
Yes, Chris.
We have a question. On bullet point number 2, you mentioned insurance might be a good way for family members who are in the business to buy out family members who are not in the business. Would you recommend that that be mandatory, that the non-participating family members must be bought out? Does that make sense?
Yes. 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 I think it's essential that the family agree that if you're not going to be actively employed in the family enterprise, making it your career, then you shouldn't own any stock. You shouldn't be an owner of the enterprise, because I have had very few occasions where non-employed owners are making any kind of contribution on a positive basis to the enterprise. In fact, it's just the opposite. Usually they're sniping at the operators of the business, etc. And in order to be fair, we've got to get the non-employed members of the family enterprise some kind of economic benefit. That's why the life insurance is one of the easiest ways to do that. Sometimes maybe they'll be the beneficiaries of the 401k in lieu of getting a piece of the business. Maybe they'll be the transferees of the real estate, which is leased back to the operating business. There are various ways to do that, but life insurance is by far the most inexpensive way to assure that the non-employed family members will get economic benefit on a tax-free basis, because you can put it into an irrevocable life insurance trust, as we'll talk about.
Okay, great. Thank you.
I'm on slide 5, nuts and bolts of assembling a succession plan. And as I hopefully you're going to come away from this discussion with, I try to approach a plan in a diagram basis, in the sense that there are certain things, the 3 whats we've already talked about, and now the 4 Ds, which impact virtually every single family enterprise, every single privately held business, and I would suggest even every single relationship. What happens when the owner dies? Should the owner be required to sell their interest in the enterprise? Or should the owner's interest in the enterprise be allowed to pass to their surviving spouse and their children? Do the successors or the surviving members of the enterprise want to be partners, have the deceased owner's surviving spouse, lawyer, CPA, and trust officer sitting at the board meetings, having input into the operation of the business, or they prefer not to have that be the case? Do they want the owner, deceased owner's children to assume their ownership interest? And is there therefore an assumption that once they assume an ownership interest, they will also assume a salary and a position of authority and employment in the organization? That's where it gets really sticky, because in virtually all closely held enterprises, the value of owning the enterprise is usually in terms of salary / compensation, benefits, etc. It is not usually in the form of S corporation distributions, limited liability company distributions, or dividends, because those are not tax deductible. So the enterprise usually gets the economic benefit to the owner of the enterprise through some kind of compensation system. And if you're not active in the enterprise or cannot make a positive contribution to the enterprise, should you be an owner? And if you should be an owner, how do you get economic benefit from your ownership interest? So it's one of the key components that we talk about when we start discussing a succession plan, is what happens if somebody dies? Are they required to sell? And if they're required to sell, then let's go ahead and insure their lives. And obviously, death is pretty easy in the sense that we can go ahead and have a value determined by an expert or agreed upon if the owners of the business are not related to each other. Section 2703 of the Internal Revenue Code would not allow related parties to stipulate a value, but if the parties are not related to each other, then they theoretically could stipulate a value. But certainly a determination of value is essential to determining perhaps how much the insurance should be. Right. And the second one is disability. What if an owner becomes permanently disabled? The question becomes, is that owner an essential member of the enterprise? Is their inability to contribute to the enterprise sufficient cause to have their ownership interest terminated? Should they be bought out? And if they should be bought out, are they going to need to be replaced? If they're going to need to be replaced, how do we buy them out? In some cases, we use their salary that they're now no longer going to be getting as part of the buyout over installments. But we also need perhaps some portion of that salary to replace them. Now, when you're talking about disability, when an owner can't contribute any longer, you have to examine the nature of the enterprise itself. If it is a law firm like mine, if you can't practice law anymore, your value to the enterprise is virtually nil. If you are a member of a limited liability company that owns commercial real estate in 3 or 4 states, and you can hire full-time, quite competent real estate managers to manage that property, collect the rents for you, pay the expenses, the taxes, the insurance, deal with the tenants, etc., does an owner's disability impact the value of the enterprise? Probably not. So when you're providing a succession plan, you must determine what happens if an owner becomes unable to practice. And clearly when you're talking about becomes unable to practice or contribute to the business, 50%, 75%, what is disability? And quite often what we do is we use a mechanism whereby if the surviving or healthy owners, if you will, think that an owner is disabled, they would then insist that that owner be examined by a physician and paid for by the company. If that physician determines that the owner is unable to work, then they're considered disabled. If the owner does not think that they're disabled, perhaps they get a second opinion. If the two opinions are opposed to each other, then perhaps a third physician chosen by the two physicians, or perhaps chosen by the dean of the Weatherhead School, or the Case Western Reserve School of Medicine, would pick the physician to render the third opinion. Because disability, again, if someone is 60% disabled, does that mean their salary is just cut modestly? Are they, if they're 75% disabled, does that mean they have to sell? It can be a difficult thing. The third bullet point there on my slide 5 is departure. What happens when an owner leaves? Owners get burned out. They say, I'm done, I can't do this anymore. Owners want to retire. Owners sometimes get fired. Owners sometimes do not perform well. They leave the business for lots of reasons, and often before the business has realized its peak performance, sooner than their partners had expected them to. We were supposed to work together until we're age 60 and 65, and you went out at 55. I'm not sure I want to be left with the enterprise without you. I think that's unfair. I think you should take a discount over what you would otherwise get if you stayed here. There's lots of things that have to be considered when an owner wants to leave the enterprise. And then the fourth bullet point, and the fourth of my 4 Ds, is discord. And sometimes I've used the term divorce, but people took that too literally. But clearly a divorce of an owner can impact the other owners as well. But the key in discord is if the owners can't resolve their disagreements over the strategic direction of the company, perhaps, or over how they compensate each other, perhaps, or over whether they should acquire another company, whether they should expand, whether they should buy real estate, etc., then the business itself can implode if there's a possibility of deadlock. So if the owners can't resolve those disagreements, should they in fact have some form of exit strategy that will allow them to buy the other owner out so they can continue the enterprise without interference? That's part of what you have to assess when you're considering an effective succession plan. I'm going on to slide 6. So let's talk, since our topic is using life insurance in your succession plan, let's see how we might be able to ensure some of the 4 Ds, some of the risk and complications attended to the business that are part of the 4 Ds. Certainly, an owner of a business can provide economic value to their family independent of the business if upon their untimely death, their interest is cashed out. Their interest can be cashed out through the cash proceeds, assets of the enterprise, or through a life insurance policy that is either owned by the other owners of the business or owned by the business itself, a so-called redemption vehicle. This is the best way to go ahead and make sure that the survivors, or that the deceased owner's survivors will get economic benefit because they don't want them to be dependent upon the enterprise. In addition, and I had this case 25 years ago, if the deceased owner's life is insured and the owner of the life insurance policy is the corporation, you want to make sure that the corporation is obligated to use the life insurance proceeds to buy the stock of the deceased owner's estate. In the case I had 25 years ago, the deceased owner had a significant life insurance policy on their life. The business was not faring very well, and the other owner of the business, when the life insurance proceeds were received by the corporation, instead of triggering the buyout, which is what the insurance proceeds were to be used for, decided to put the insurance proceeds into the business, and the surviving spouse continued to be a shareholder. Well, you can imagine what happened. The business did not fare well. In fact, ultimately the business went out of business, and the insurance proceeds were consumed in the operations of the business, and the insured decedent's estate never saw any economic value from their ownership interest. So, I mean, that is a very, very bad result, as you might imagine, and one that we try to avoid by making sure that the stock redemption or cross-purchase or close corporation, buy-sell, whatever you want to call it, agreement requires that a down payment be made upon the buyout of a deceased owner's interest, and that the down payment be the greater of some percentage of the purchase price or the amount of available proceeds of life insurance on the owner's life. Because you want the life insurance to be used for that purpose, not to be used to maintain the business. If you need life insurance to maintain the business, that's a different policy, a key man policy, for the purpose of replacing the lost owner, not for the purpose of buying out their interest. We like life insurance on bullet point number 2 there because it allows the survivors to operate the business and meet their final obligation to the decedent's family. And if you look at it, bullet point number 3, insurance allows the survivors to acquire ownership at a discount. And what I mean by that is the life insurance premium, and I don't know if we have any life insurance people on this webinar, Dan, is that a life insurance premium tied to the death benefit, what is called an internal rate of return basis, for example. If the life insurance premium for $1 million is $10,000 a year, obviously if the person dies in the first year, that's like winning the lottery. You've spent $10,000 and you've received $1 million tax-free. Now, if in fact you pay $10,000 a year for the life expectancy of that insured, so let's say that insured's life expectancy is X. The insurance companies tell me that the premium payments, if paid until the life expectancy of the insured, the internal rate of return to the beneficiary of that life insurance policy is about 12%. So if you're paying life insurance premiums and you die within your life expectancy, you're earning somewhere between 9 and 12% on the premium dollars versus the ultimate death benefit. So therefore, if you are the potential buyer of the business, the premium should give you a discounted purchase of the enterprise as opposed to 100 cents on the dollar, which is what you would have to do if you were making installment payments. I'm on slide 7 now, and we continue to talk about insuring the 4 Ds. Permanent insurance provides access to tax-free cash. What I mean by that is the cash surrender value in a whole life policy or in a variable policy or in a universal policy accumulates inside those policies and compounds, if you will, on a tax-free basis. Then those cash surrender value proceeds or universal life proceeds or variable life proceeds inside the policy can be borrowed out to pay a disabled owner over a period of time. So in my insuring the 4 Ds, if an owner becomes unable to make a contribution to the enterprise, then some portion of the life insurance on their life can be utilized, the cash surrender value portion, to start making installment payments to them to repurchase their interest or to pay them disability benefits over time. Then the second bullet point, upon their ultimate untimely death, the paying entity which owned the life insurance can then recover their cost on a tax-free basis with the death benefit. So permanent insurance, if you've got a permanent insurance need, can be a great vehicle in succession planning as it goes ahead and it creates a tax-free vehicle that can be taken out of the policy without impacting the cash flow of the enterprise and go ahead and address both a death benefit under the 4 Ds, a disability benefit, and obviously you can address a lifetime buyout for the departing shareholder. I'm on slide 8. Chris tells me I've got, well, you told me about 5 minutes ago I had 20 minutes left. Chris, what have I got, about 15 now? Would that be accurate?
Yes, Jim, that'd be about accurate.
Okay, good.
A few minutes here or there.
Okay. And those of you who are listening, if you have questions, please interrupt. I'm on slide 8, nuts and bolts of assembling a succession plan. And this is what we had talked about before when we talk about the discord portion of a succession plan. If the owners can't agree on the strategic direction of the company, their continued disagreement may eventually tie the hands of the enterprise to such a degree that it implodes, which is a devastating result and should be avoided. And part of the succession planning process is to develop mechanisms that would avoid such an implosion. One of the things we talk about is the put. The put is where the seller tenders his or her shares with the entity to the other owners, and the other owner is required to buy. Now, a put usually comes in the context of I want out, I want to depart, my third D, I want a departure from the enterprise, and because I am forcing you, the remaining owner, to buy me out, I'm agreeing to a discount. For example, if my share of the business is worth $2 million, I'm going to take a 20% discount. If the agreement calls for you to pay me over 5 years because I'm forcing you to buy me out before you really want to, then I'm going to be forced to take the payments over 10 years. And if the payments are to be paid to me at the applicable federal rate, well, because I'm forcing you to buy me out, you can pay me 200 basis points less than the applicable federal rate. The call is the corollary, just the opposite of that. If I come to you and say, you're making me crazy, the business is in trouble with you here, I want you out, I want to buy you out, I am forcing you to sell to me, then I need to pay you a 20% premium. Instead of paying you over 5 years, perhaps I've got to pay you over 3. And instead of paying you at a discount, I've got to pay you at a premium in terms of an interest rate. And, of course, I have to personally guarantee, et cetera, et cetera, et cetera. So the put and the call is a very good mechanism to go ahead and provide an exit strategy should the owners, in fact, have ultimate discord. They need a divorce. Now, the problem with the put and the call is that nobody wants to agree on a price. So the push-pull mechanism is a mechanism that does, in fact, eliminate that problem. But the push-pull is I come to the table as an owner of the business, and I say, I am willing to buy you out at $2 million over 10 years at the applicable federal rate, and I personally guarantee it as long as you agree to a non-compete. And I'll go ahead and I'll provide collateral through life insurance in my life, and if necessary, give you a second mortgage on my home. So I've set out all of the terms of the buyout in detail, right down to the collateral, the non-compete, the interest rate, and the installments, as well as the price. Now you, as the person who receives my offer to buy you out, you have the right to go ahead and accept my terms, or you have the right to accept my terms but change the transaction from you being the seller to you being the buyer. Now, the reason the push-pull mechanism works so well is that it's a deterrent to inappropriate puts and calls. When I say inappropriate puts and calls, that's where somebody is going to try to force somebody out and thinks they can force them out at significantly less than fair market value. When a person triggers a push-pull mechanism, they don't know ultimately whether they're going to be a buyer or a seller. And because they ultimately don't know which one they're going to be, then they have to make sure that the price that they have offered, the terms that they have set, are reasonable. Because they either have to pay those terms or they will receive those terms. So if, in fact, they are not reasonable, then they are going to be hurting themselves. It's a very effective way to get a succession plan exit strategy in place. Because the biggest disagreement always is, what is the value of the enterprise? I'm the most important aspect, so I'm not going to pay you very much because you're not a very important aspect. Or if I'm the seller, I'm the most important aspect of this business, so you have to pay me a premium. Now, with the time we have left,
Jim?
Yes.
I got a text question. Are those push-pull mechanisms and the put and call, are they usually put in the, let's see if I read this right, the buy-sell agreement, or are they a separate agreement generally?
They're usually in the buy-sell agreement. That's exactly where they should be.
Okay.
They should be part of the buy-sell agreement. For example, on slide number 10, I referenced their bullet point number 3, the cross-purchase agreement or redemption agreement. They would be part of those agreements.
Okay.
They would be that would be the exit strategy. Pardon me. It could be part of a so-called close corporation agreement. Could be part of a so-called operator agreement, which is basically the agreement that is the underlying instrument for a limited liability company. So it's really just a matter of the draftsperson's preference, but clearly to be effective, they have to be in writing and agreed to by the party. Now, the insurance vehicles to really consider using: the irrevocable life insurance trust and wealth replacement trust. Wealth replacement trust is simply a fancy name for an irrevocable life insurance trust. In other words, when you want to go ahead and, in my first example of the three whats, what is fair to the generation or to the members of the family who are not actively employed in the business? Well, if we're going to sell the business to the ones actively employed at $2 million, and the business is really worth $5 million, then we've got $3 million of wealth we need to replace. Well, we can do that through an irrevocable life insurance trust, where the trust actually owns the life insurance. The premiums are paid in some fashion by the participants in the enterprise, and ultimately, when the life insurance proceeds are received upon the death of the successor or the survivor of mom and dad, for example, a second-to-die policy, that wealth, that $3 million, goes to the second unemployed generation on a tax-free basis. That is a very, very effective way to pass wealth through the use of life insurance, and can be instrumental in keeping family harmony, where their closely held business is part of the family's net worth. Cross-purchase agreement is an agreement between the owners, where each owner owns a policy on the other owner's life. And if an owner passes away, the insurance proceeds are received by the other owner, who is then legally obligated to use those proceeds to buy the ownership interest of the insured deceased owner's interest and pay their family. And that's where you would put in that language that says that upon a deceased owner's death, the buyers are required to make a down payment of, let's say, 25%, or the available proceeds of life insurance on the insured deceased owner's life, whichever amount is greater. A redemption agreement is the same exact agreement as a cross-purchase. However, the insurance is not owned by the other owners. The insurance is owned by the enterprise itself, and the enterprise itself, whether it be a corporation, a limited liability company, a partnership, etc., is the party obligated to repurchase a deceased owner's interest. Redemption agreements are quite useful to avoid multiple ownership of policies. For example, in a cross-purchase agreement, if you have 4 shareholders, then each shareholder has to own 3 policies on each other shareholder, so you have 12 policies. Whereas in a redemption agreement, if you have 4 owners, you simply have 4 policies, one on each insured owner's life, owned by the entity itself. Redemption agreements, because the life insurance proceeds may be subject to the alternative minimum tax in a C corporation, are not as popular as they used to be. They're quite useful in S corporations as well as limited liability company LLC arrangements. Corporate-owned life insurance that is payable to the corporation, for example, key man life insurance, that sort of thing, can be extremely useful. Section 6166, which is the 14-year installment payment of taxes, the insurance can be used as a mechanism to fund those installments or to make the down payment. And Section 303 of the Internal Revenue Code allows a corporation to take funds out on a tax-free basis from the corporation to the extent of the taxes and expenses of an estate without that withdrawal being treated as a dividend. And so that life insurance proceeds can help fund that non-taxable dividend payment to the estate of a deceased owner to provide liquidity. A bonus plan. A bonus plan is a